Section 18 introduces significant changes to how carbon capture and storage, CCS for short, decommissioning funds are treated for tax purposes. This addresses a key barrier in the transition from oil and gas to carbon storage infrastructure. Previously, oil and gas companies could only claim tax relief when actually performing decommissioning work, not when making payments into decommissioning funds. This created a substantial disincentive for transferring assets to CCS companies, as the transferring company would lose potential tax relief. Under the new provisions in Schedule 3, qualifying payments into CCS decommissioning funds are now treated as decommissioning expenditure for tax purposes. For a payment to qualify, it must be made in accordance with the Energy Act 2023, involve eligible CCS installations or pipelines, qualifying for change of use relief, and represent the estimated decommissioning costs. The relief applies under 4 tax acts: the Oil Taxation Act 1975, Capital Allowances Act 2001, Corporation Tax Act 2010, and Energy, Oil and Gas Profits Levy Act 2022. To be considered relevant transferred plant or machinery, assets must have been used in ring-fence trade and must be offshore installations, submarine pipelines, or relevant onshore installations transferred to a licensed CCS company for reuse. Important safeguards prevent double relief, ensuring companies cannot claim relief both when paying into the fund and when actual decommissioning occurs. Additionally, amounts received from CCS companies for transferred assets are excluded from energy profits levy calculations. This change removes a significant obstacle to repurposing oil and gas infrastructure for carbon storage, supporting the UK's transition to net zero while ensuring appropriate tax treatment of decommissioning obligations.